Imagine this. You just survived another exhausting month at work, long shifts, annoying customers, constant stress. Finally, payday arrives. You're lying in bed when your phone buzzes, a new email. You've been paid $2,000. Nice. But then you open your banking app, and instead of $2,000, you only see $1,456. Wait, what happened to the rest? You scroll through your pay stub, federal income tax, state tax, Social Security, Medicare. Just like that, hundreds of dollars disappear before you ever touch your money. Welcome to the financial system, a system that affects every dollar you earn, every dollar you spend, and every dollar you try to grow. Let's start with the first thing everyone loves to hate: taxes. Taxes are basically the price of living in a modern society. They're how governments pay for roads, schools, hospitals, public services, infrastructure, and thousands of things most people never think about. But here's the interesting part. Taxes don't just happen once, they happen constantly. You earn money, tax. You spend money, tax. You invest successfully, tax. It's almost like every dollar you make has multiple people waiting in line to take a piece of it. Now, to be fair, taxes aren't entirely bad. Countries with stronger public services often collect more taxes. But whether you love them or hate them, one thing is certain: taxes reduce the amount of money you get to keep. And once your money survives taxes, most people send it to a bank. Which brings us to our next financial mystery. Most people think banks work like giant vaults. You deposit money, the bank stores it safely, and that's the end of the story, right? Not exactly. In reality, banks don't just store your money, they use it. Let's say you deposit $1,000. Most people imagine that exact $1,000 sitting safely inside a vault somewhere. But the truth is, the bank takes most of that money and lends it to someone else. Maybe it's a family buying a house, maybe it's someone financing a car, maybe it's a business owner expanding a company. This system is called Fractional Reserve Banking, and it works because banks know something important. Not everyone will try to withdraw all their money at the same time. As long as people trust the system, everything works smoothly. But when trust disappears, problems begin. History has shown us exactly what happens when everyone rushes to the bank at once. It's called a bank run. People panic. Everyone wants their money back immediately. And suddenly, banks don't have enough cash available. That's why governments created protections and insurance systems. Because modern banking runs on one thing more than anything else: trust. But banks aren't lending money out for charity. They're doing it for profit. And that profit comes from something called interest. Interest is one of the most powerful forces in finance. And depending on which side you're on, it can either make you rich or keep you broke. Here's how it works. Imagine borrowing $1,000. A year later, you might owe $1,100 or $1,200 or even more. Why? Because the lender charges you for the privilege of using their money. That's interest. Money, in a way, charges rent. If you're borrowing money, interest is the cost. If you're saving or investing money, interest becomes your reward. And this is where things get really interesting, because interest doesn't always grow in a straight line. Sometimes it grows exponentially. This is called compound interest, and compound interest changes everything. At first, it looks boring. You invest a little money, you earn a small return. Nothing exciting happens, but then those returns start generating their own returns. And those returns generate even more returns. It's like a snowball rolling downhill. Small at first, then bigger, then massive. This is why many wealthy people aren't necessarily financial geniuses. They simply gave compound growth enough time to work. $100 becomes 200, 200 becomes 400, 400 becomes 800, and eventually, years later, the results become life-changing. But remember, compound interest has a dark side, because debt compounds too, and that's where many people get trapped. You buy something with a credit card, miss a payment, interest gets added, then interest starts earning interest. Before you know it, a small purchase turns into a giant headache. The same force that builds wealth can also destroy it, which means the goal is simple. If you're paying interest, get rid of it quickly. If you're earning interest, give it time. Lots of time. Now let's talk about an invisible thief. A thief that's quietly stealing money from almost everyone. Inflation. Inflation doesn't physically take money out of your wallet. Instead, it reduces what your money can buy. Think about it. A few years ago, a certain amount of money bought more groceries, more gas, more housing, more everything. Today, that same amount buys less. Your money didn't change. Its purchasing power did. That's inflation. And inflation happens for many reasons. Sometimes demand rises faster than supply. Sometimes production becomes more expensive. Sometimes global events disrupt entire industries. And sometimes expectations alone can push prices higher. The tricky part is that inflation often feels small. 2%, 3%, maybe 5%. But over time, those numbers compound and the effect becomes enormous. This is why simply saving money isn't enough, because while your cash sits still, inflation keeps moving quietly, relentlessly, year after year, which is exactly why investing matters, because if your money isn't growing, it's usually shrinking. When inflation gets too high, governments try to slow things down. One of their favorite tools is raising interest rates. Higher rates make borrowing more expensive. Loans become harder to afford. People spend less money. Businesses expand more slowly. The economy starts cooling down. And if things slow down too much, a recession can happen. A recession is essentially a period where economic activity declines. Companies earn less. Hiring slows. Layoffs increase, consumers become cautious, and uncertainty spreads. Think of the economy like a giant party. During a boom, everyone's having fun, money flows easily, businesses grow rapidly, people spend confidently, but eventually, reality shows up. The music gets quieter, the excitement fades, and people start paying attention to their bank accounts again. That's the recession phase. But here's the good news. Recessions don't last forever. They feel permanent while they're happening. But historically, economies recover. They always have. Growth eventually returns. Businesses adapt. Innovation continues. And the cycle begins again. Now let's talk about something that secretly affects major financial decisions in your life, your credit score. A credit score is basically a trust score. It's a number that tells lenders how risky you are. The higher your score, the more trustworthy you appear. And trust has value. A high score can help you qualify for better loans, lower interest rates, better financial opportunities. A low score can make everything more expensive. So, how is it calculated? Payment history, credit utilization, length of credit history, credit mix, and new credit applications. In simple terms, pay your bills on time, avoid maxing out credit cards, be consistent, and over time, your score improves. Think of your credit score like your financial reputation. Building a good one takes time. Destroying it can happen surprisingly fast. Now, here's where things get philosophical. What is money really? Most people never ask this question, but they should, because money isn't actually valuable on its own. A dollar bill is just paper. A digital bank balance is just numbers on a screen. Even gold only has value because humans collectively agree that it does. Money works because of trust, because billions of people participate in the same system. Without that trust, money becomes meaningless, which means wealth isn't really about collecting pieces of paper, it's about owning things that create value. And that's where investing comes in. Investing is how you put your money to work. Instead of trading time for money forever, you use money to generate more money. You can buy stocks, bonds, funds, real estate, businesses. The specific investment matters less than the principle, because the real goal is simple: to own assets that grow faster than inflation. The people who build lasting wealth usually aren't chasing shortcuts. They're not searching for magic tricks. They're simply patient, consistent, and disciplined. And finally, let's talk about the most valuable asset on earth. Not money, not gold, not real estate. Time. Time is the one thing every wealthy person wishes they had more of. And it's the one thing every young person has more of than they realize. Because wealth isn't built in days, it's built in decades. A small amount invested consistently over a long period can outperform massive amounts invested late. That's the true secret. Not luck, not genius, not perfect timing. Time. The earlier you start, the more powerful compound growth becomes. And that's why understanding finance matters. Because every financial decision you make today affects the future version of yourself. The version that's 10 years older, 20 years older, 30 years older. So learn the rules, understand the system, invest wisely, avoid unnecessary debt, create value, and most importantly, give your money time. Because people who understand money work for a living, but people who understand time build wealth for a lifetime.